All right, so on today's show, I want to talk about what we're calling the growth code. So there's this great debate of, do you go and chase high yield? Because I don't know too many of our clients that are like, hey, I found this great 2% dividend.
Right.
They're always like, hey, have you ever checked out so-and-so? It's paying a 9%
or 11.
Why aren't we invested in this one?
That's
right.
Get that all the time.
But I want to talk about the debate of dividend growth versus high yield. Okay, so high yield, we're talking dividend stocks on both sides of the equation. But there's that higher yield, so we're probably talking 6% or higher
right now
versus a dividend growth that might be at 3 or 4%, but it's growing its yield.
Mm-hmm.
Okay, so this is kind of the setup of the show today. And it's kind of an interesting discussion because the average investor would kind of look at this and go, you know, how in the world could a 3% yielding stock outperform a 6% yielding? It'd have to grow 100% just to get to where that one was.
Right.
You know?
Quick.
And that's that if you had 1 penny double every day.
Oh, yeah.
How many days would it take to hit $1 million?
Yeah.
I didn't look it up, but it's like, it's
crazy.
It's like 17 days.
Yeah, it's nothing
like that.
It's something wild.
Well less than, or was it $1,000 at 17 and then it gets to $1 million and 30 or something crazy. 1 penny. Okay, so why are we so, I mean, this is going to be the easy, but why are we so attracted to the high yield? Why do we think that's the best?
Oh, that's the immediate payment.
It's the now,
especially through dividend investing. That's what you're getting on that quarterly, annual basis. So who wouldn't want the most that they could get now instead of being sometimes patient?
Well, I think sometimes we believe we don't have time.
Right.
Because like, well, I'm retired or I need the money now. I want the 6%. And I have empathy around that. I get that. But the here and now, you're going to need it tomorrow too.
Correct.
So there is a delicate balance to that, you know, because a lot of clients are like, well, yeah, I need the money now, but I need it for the next 30 years.
Well, and we all know that, we can argue the rate of inflation, but it is true. It still happens. So you may be living comfortably today, but exactly to your point, what does that look like over the next 10, 20 years? And does it actually provide what you need in the future?
So we've talked about high yield before. Are there things that would concern us looking at a high yield?
Well, the stock price, the relationship to the stock price may be, without going onto a tangent, the stock price and the relationship between the stock price. So if the stock's not doing well, or if it's doing really well, it's going to change the yield in a matter of no time.
Yeah.
Well, we've talked about what I would consider
I didn't
a
say
trap.
that very well, but
That's okay. I'm
Yeah.
going to help you.
You got to be careful with cash flow too.
There's a yield trap here.
Yep.
That if you have a high yield, that means the stock price went down.
Yes.
And which is pushing that yield up. And there is a trap because sometimes, sometimes you look at it and you're like, wow, that's super attractive. I got this awesome stock. It's paying 9% and this is great. And you don't realize that stock is in free fall mode. You caught it at the 9% yield. It's on its way to 15 and ultimately going to cut that dividend because it can't afford to pay it because the free cash flow is falling apart or whatever. Yep. The revenue's going down. Who knows what the story is behind it. And you just got the thing and you're like, and all the signals say buy. Right. Because the stock price is down 30%. Right. But when you dig into the financials, there's no support to pay that dividend. And that's something we've been looking at a lot lately is how much cash does a company hold and how long can they afford to pay their dividend? Sometimes you get sucked into some really awesome information and sometimes you breeze over it. But knowing how long a company could sustain its dividend is really, really important.
Sure. And
what's their trajectory of their free cash flow? How much money are they bringing in and have free to pay out all these different things? Those are very important things. We've talked about this so much on
we
the
got
show.
great shows about that.
Yeah. But the reality is we are always going to be attracted to a high yield stock. Always. On the flip side, we've got, the lower, the what we're calling the power of dividend growth, but it's the low income ones, It's the ones that, are paying 3%. We got a stock in our portfolio that when we bought it, it was like at 5. And I think right now it's like 1.3.
It was like it was 1.3 or 1.4 yesterday.
Which
it's done nothing but just grow and explode and do everything exactly right. But you're like, why is your yield so low?
bad? And of the clients that have been in it since its beginning, I think they sold out their original deposit like within a year and a half.
Yeah.
We've got clients that have made so much money in that position. It's house money at this point, and we've used all the growth to supplement entire positions in our portfolio, and it continues to grow. And then we'll still have clients, nobody really complains about it, but like their yield's so bad.
Right.
But do you have any idea how much money you've made in that and how many other positions you own with the profit from that one company?
Yeah.
Right.
And their dividend continues to increase, but it's so little.
Yeah.
But there's the delicate balance act of when do you chase yield or growth, dividend growth, and when do you turn a blind eye to actual stock growth? Because, sometimes it makes sense to hold a poor yielding stock because we know or we have this really good idea and feeling of where the stock price is going to go and what opportunity that's going to give us. But the client can't, the dividend that's paying is so bad.
Yeah.
Or they cut it, and we've had stocks cut their dividend. We've had companies lose their aristocrat status.
Mm-hmm.
We've had all kinds of things happen. And yet more often than not, our clients have made out, even though we didn't sell right away. We got another one of those in our portfolio right now.
Yep.
That we look at what's the best solution.
Well, time in the stock market, patience usually is rewarded.
Patience is always, well, I shouldn't say always,
but it's usually rewarded.
Yes.
Just be patient, allow it to kind of settle. Typically will turn out all right.
So let's talk about this aristocrat or really what is dividend growth? Like, what are we looking for there versus a high yield? Like,
It's a great thing for a company to pay a dividend. But a lot of times you have companies that pay a dividend. They may consistently pay a dividend, but it could be all over the place. It's almost like a profit share. It's like, hey, how did we do this year? And we're going to pay a dividend and let you share in those profits. But there's no consistency to it.
Mm-hmm.
A dividend grower is someone who's consistently paying a dividend, but then is also consistently increasing it. And that's really what we try to look for. Yeah. In what we're trying to put in our clients' portfolios is those growers, because we know that over time you're going to need more income. So if we can get you predictable income and it's predictably growing, then we're in a good spot.
So the best example I could give somebody here is like a pension, not a government pension, which I think is mafia money because it doesn't exist, where you get, you've worked for 30 years, they're going to give you a payout of, $100,000 of service, or they'll give you $50,000 a year of income. You're like, how does $100,000 pay me $50,000 a year? Like, it's mafia money. But you have this pension, this static income where you exchange your time, they put some money into it, and you have this payout value of hundreds of thousands of dollars that you can take and invest versus a static monthly amount of income that is going to remain that amount for the rest of your life. That is a typical pension.
Right.
When it's not related to the government with their blank checkbook.
Yep.
With companies that actually have to do accounting, you have a static amount of, say, let's just make up a number, $4,000 a month, or they'll give you hundreds of thousands of dollars once and never pay you again. And the debate is, what's going to be your best decision? Do I take this static $4,000 a month and then inflation's going to erode it over time? Or do I take my chances and take this one lump sum, which if I invest it would be lower than this 4,000 initially,
Yep.
most of the time,
Yep.
But could I outgrow it in the future? And this is a big debate. And depending on the numbers,
and don't forget the legacy.
Depending on the numbers, well, and when you die,
it's a big one.
When you die on the pension side, the $4,000 a month, it goes away.
Stops.
And if you're married, you can set it up where it dies when you die and the spouse gets nothing, or you can take less than the $4,000, might be $3,000 or $3,500, and then if you die, the spouse gets it.
But either way, once
You both die,
Either way, yes.
it's gone.
it's done.
And that's a big one.
On the lump sum, you might take less initially, but you can grow that over time, and that money remains
Never
even after you
stops.
die. It never
Right.
stops. So how do you do the math behind that? And how do you understand that? Well, we have an awesome planning software called History. But the reality is you have to do some projections. We know the one is going to be 4,000. It's never going to change.
Yep.
The other one, you start lower, and this is where the math comes in. If you have a 6%, say this one over here, the $4,000, it was 6% out of the gate. It's never going to change. So in 5 years is $4,000, in 15 years is $4,000, in 30 years is $4,000. It never changed. What's inflation going
Right.
to look like in 30 years? That $4,000 is going to get destroyed. On this side, you might start with 4% income, 5% income, which is not going to equate to 4,000, but that might grow at 5, 10. I mean, our average income, our portfolio growth has been significant. It's been north of 10% since we've started it. I mean, our history of income increases every year is super strong. What happens when you have a $3,000 a month growing at 6, 8, 10% a year? Over 10, 20, 30 years, that 3,000 is going to be to 4 to 5 to 6 to 8,000 a month. So you're going to have, and we have this chart in here, nobody's going to be able to see it.
No.
But we have this awesome little chart right here where you can see a static line versus, not a hockey stick, but like a line that's growing up. So you have one that's completely sideways, horizontal, and then one that's more like it's going from the bottom left to a top right.
Yep.
And you see a growth. It's a swoop, but at the end of the day, you see one and it exceeds, that horizontal line in a relatively short period of time. But you have to have patience. You got to do budgeting. There's so much more to it. But the reality is you have that legacy value because it doesn't die when you do. The income stays. And from a total income standpoint, it's so skewed. Like your horizontal pension, let's just say you live for 10 years, that's $450,000 of income. The other one might be at like 650.
Right.
And you're getting paid more at the end of your life than when you did when you started, which is another debate. When you want to spend the money,
you want it,
well, invest earlier. Don't wait until the day you retire to go, okay, I'll buy those dividends.
Yeah.
Start when you're 20.
Got a great show about that one,
Yeah, we
too.
got a great show.
Start when you're 20.
Yes.
For the 20-year-olds in the room. All right, then the next thing, let's talk about a case study. This is a very interesting one, and then we'll end on this. This is what we're talking about. We're going to divide up the S&P into two groups. We're going to take the S&P as a whole as one, and then we're going to take the aristocrat stocks that are inside of the S&P, and that's going to be the other one.
Which is
So it's a subset.
dividend payers that have been paying more than 25 years
Right.
in a row.
Yes. So you have the S&P as a whole, 500 companies intact, and then we're just going to squeeze out just the aristocrat stocks that are inside the 500 S&P and put them in its own subgroup. Okay? And which one's going to do better? Now, we didn't pull out all the stats of what the total return is over time, but we want to look in specific instances, what happens in volatility periods, what happens in some growth periods, who's winning, who's losing, what's going on. So let's talk about 2008. What happened?
Oh, there's a little bit of financial crisis that happened thanks to some mortgages.
Yes. We had the mortgage implosion, and then which also triggered a stock market implosion.
Yep.
And as a
All
result,
the banks.
the S&P from its top to its bottom in 2008 lost about 50%. So the S&P group, the whole thing, the 500, lost 50% of its total value from the top of the mountain to the bottom of it. What did the aristocrats do?
22% negative. So, I mean, they dropped,
It still went
but
down.
not even close to where the other was.
So you had
To the full S&P.
total return loss of the full S&P of 50% loss. Total return from the top of the mountain to the bottom on the aristocrats was only 22%. That is a significant increase.
Massive.
That's huge.
Well, and then when you talk about real life and those emotions, because I mean, just the timing on being able to stay in, people would have gotten out and it may have even been worse.
Well, you get paid. I mean, there's a tether. I talk about it all the time. There's
Yeah.
a tether to dividends.
Right.
Because you're like, hey, I need my income. I'm
Yeah.
not going to sell.
Right.
I'm living on that.
Right.
Yep.
And it keeps you in.
My clients
through
have
the
reminded
emotions.
me of that over the years. Sometimes I forget because you're like, well, let's make a change. And like, what? Why?
Why?
Is it
Don't
going to
take
be
that
better
from
or
me.
worse income?
Yep.
I got to stay in the market. Like, it's not even a question anymore. Our clients
Right.
are like, don't pull me out of the market. I need my income.
Yep.
Volatility is
Right.
just part of the equation. You know, I'll be happy on this day looking. I'll be sad on this day looking. But I love my cash flow.
That's right.
That's right.
I'm going to be really happy at the beginning of the month when the dividend
when I get
checks.
those checks.
Right.
I don't like looking at my statement.
That's
you know, you still look at it and track it. Now, from a growth standpoint, they're either the same or better. Very seldom does the S&P outperform the aristocrat. Okay. Now, disclaimer here: we are not suggesting you go just buy a bucket of aristocrat dividend stocks out there.
Yeah.
The realities are dividend stocks are notoriously less volatile and has better return. That's why that's what we do.
And the better returns can be there because of the less volatility. You
Yes,
don't have as big of a hole when the S&P drops 50.
Right.
You can't just be up 50 the next year and you're back whole. You have to be up
Now you're back to
100
neutral.
Right.
Right.
the next year. And if you're at 20, if you drop 22 as the aristocrat, that's a much different hole you've got to climb
Right.
out of. So you
Right.
just get further out in front.
So let's land this plane. What are some closing thoughts?
Don't get trapped by the yield. We say this a lot. Yield is great, but you got to do some due diligence. That's what we're looking at. You got to make sure that you're not just getting blinded by the shiny yield.
And the
Yeah.
immediate part of that. Like
Yep.
don't just go for the shiny thing right now. Try to see that shiny thing out in the future and recognize that in the short term, it might not look as shiny in the
Yeah.
short term to get to the long-term shiny.
Yeah, this is a long-term process. This is not the first year retirement, first 5 years. It's 10, 20, 30 years. We got to pay attention to that, and it's too easy to fall into that trap of, I need this now, all of it, immediately.
So I have two closing thoughts. First one is subscribe to the show.
There you go.
The second one is, if you think of putting together a championship team in whatever your favorite sport is, if you want to be a champion, you've got to think ahead. You've got a game plan. I don't know of any, I'm reading a bunch of books right now on John Wooden. What an incredible coach. His career record was over 808 winning percentage.
Yep.
0.808 or whatever, which is insane. But he was so meticulous in how we ran practices. Like when every time he got a freshman class in, he would take them into the locker room and show them how to put their socks and shoes on. Could you imagine in today's environment getting some $4 million NIL kid and you're like, all right, take your shoes off, take your socks. Let me show you how to put socks on. And the whole thing was, if you don't have your socks on properly and your shoes on, your foot's going to slip and you're going to injure yourself. You're not going to be able to play on the court. And he was so meticulous in little things. And if you're going to build a championship income stream, then you have to be meticulous. You have to think ahead. It's not just on what I can get now. Yes, we all want to win the championship, but you have to game plan. You have to strategize. You have to understand not just what's good for today, but what's good at halftime, what's good in the third quarter, what's good by the end of the game. And sometimes you gotta suck it up early to win late.
That's why they have the draft, right?
That's
Go
right.
pick up some of those young players, develop them, and they can be your rock stars for a long time.
And somebody who wasn't good in college might be killer in the pros. And sometimes there's busts.
That's
we all
it.
know the bust.
Yeah.
All right. So hope you enjoyed today's show. God bless.